on your whiteboard. Okay. Good morning. We will go ahead and call to order our Oklahoma City MAPS Investment and Operating Trust meeting for November 21st, 2022. Item number 2 is approval of the minutes. They were included in your packet. If there's no changes or corrections, I'd take a motion and a second to approve. Please cast your votes. The motion passes. Thank you. So now moving on to item 3, presentation of investment performance review, period ending September 30, 2022. I believe Doug Anderson is here with ANCO to present. Good morning.
Good morning, Madam Chairperson and trustees. Am I able to drive? All right, let's give this a shot. Good morning. It is mid to late November. We're going to start by going over the September 30 report. We've been investing this trust since March, and it's not exactly been the best time to start investing. I think we all know this. It's been a very challenging year for investors, one of the most challenging years that I've ever experienced in the markets. And that's because, bless you, that's because equities, which are going to be the driver of our long-term returns over the course of this trust, have gone down, but also the risk-reducing asset or fixed income bonds have also gone down at the same time. And it's remarkably unusual to see this, especially as much as bonds have gone down this year. Nonetheless, we hold certain long-term investment truisms, and those are you're paid more to own equities than fixed income, but they can be combined fruitfully into a portfolio, usually to reduce risk. So our long-term investment premises are not changed. We accept that risk is always ever present in markets, and I think that this year is a unique way to look at that. I'm going to briefly go through market environment just to give us context of where we have been so far this year, and you can see that all of the investments here have been negative except for cash. You can see that equities on the top chart are down 5% for domestic equities or less. You can see international equities are also down, but most troublesome for us this year has been fixed income. It's down almost 5% for the quarter. It's down 15% for the year. And prior to this year, the worst calendar year return for this aggregate bond index has been negative 3%. However, we started with interest rates very low. Inflation is the kryptonite to bond prices, and that's what's caused this time. Now, going forward, I want to step back for a second and say, so going forward, when prices go down and you're able to buy investments for lower cost than previously, you're looking forward, returns look better. And one thing that we pay attention to are what are called capital market assumptions. This is the time of year that think tanks and investment banks are putting out their capital market assumptions for next year, and they are significantly higher than they were a year ago because all investments have gone down. We're seeing going forward capital market assumptions for fixed income, for core fixed income portfolios be 4%, for high yield fixed income, which we have a small allocation there, above 8%, which it's been a decade or more since we've seen that kind of return assumption for our low-risk assets going forward. On the equity side in the United States, you can see where the trailing year returns have been quite negative. You've seen the reemergence of value investing versus growth investing. Value stocks are typically banks, insurance companies, energy, raw materials, right, fairly basic. Growth tend to be more services, software, healthcare, et cetera. 2 years ago, those were the leading companies in the index. This year and a half, it's been energy has been the only positive place to be invested in the markets. Facebook or Meta, one of the best performing companies on a decade, is down 72% this year. So you can see when growth stocks stop growing or stop being the darlings of the market, they tend to trade off very badly. Our domestic equity investments are in index funds, and so it shows you what's been going on in the market, and it does self-correct in an interesting way. This is the index. The Russell 1000 is the large caps in the U.S., and this is a tremendous picture to see how one-sided the market has been this year. On the light blue column there, that is the trailing year return for the various sectors of the market. There are exactly two that have been positive this year. Utilities, the most defensive sector of the market, up 5.5%. But then energy, coming back from one of the longest fallow periods that I've seen for a sector, up 46%. And if you take that through the end of October, October was an exceptionally good month for energy. It's up better than 60% for the year to date, or for the trailing one-year period. And its return differential compared to technology is more than 100%. So 100% different in the return for energy versus technology over the last year. I'm not going to spend a lot of time going into tremendous detail here. International equity are down worse than the U.S., and a big part of that is the strength of the dollar. The U.S. dollar is the reserve currency, default reserve currency of the world. Problematic things happen in the economy, in the world's economy. Folks tend to translate into dollars. That makes it stronger. And it translates returns in from non-dollar currencies at a lower rate. You will notice one thing on this chart. We have the two big divisions of countries and markets out there. The top is going to be your EFA, and the bottom are the so-called developing countries. Notice that Russia is no longer in this developing market index. They were kicked out earlier this year, right after the invasion, and it's effectively an uninvestable index for institutional investors. Notice on the developed markets here, the two largest countries are China and Taiwan, and of course we're watching that very carefully, because if you add those two up, it's 13% of 29% of the overall index, so we're almost half of that index is China and Taiwan, which if there is a conflict there, that can be very problematic for the entire index. Moving on to fixed income, again, this is where it's been, the equity market is painful, but we see equity markets like that every 3 years or so before they recover. If you see the bond market returns here, this is incredibly unusual, and it's because we have extremely high inflation for modern era in the United States, and the yields on these bonds were so low coming out of COVID that there was no cushion there for the returns. But again, when a bond price goes down, the yield goes up. And for us looking forward, that yield is the most important thing, because bonds are contracts. We buy them on day one. We know the maturity date. If the price goes down, the income goes up until we get to maturity, and it matures at par. So we'll continue to collect income, and the ultimate maturity of that bond will be given par back. So it's not as bad as it initially looks, because we're going to have somewhat of a compensation of this loss for the term of the bonds in the portfolio. But again, this is highly unusual. Bonds aren't supposed to go down 12% per year. It's not supposed to be that way. The only other times that the domestic bond market has seen losses like this has been right after the Revolutionary War and during the Civil War, when it looked like the United States would not be an ongoing concern. And I don't think that we're in a similar situation right now. The yield curve here, this is what we hear a lot about. We're certainly in the period where it feels like this is the most talked about recession that we've ever had, that we're not in a recession. U.S. real GDP growth is expected in the fourth quarter to be above 4%. That's not recessionary, but all I hear when I watch the news is that there's a recession coming sometime next year, and it's moved from third quarter, fourth quarter of this year to summer or fall of next year. And honestly, with a 4% real GDP growth, that's very strong. And that's what's expected for the fourth quarter of this year. But if you look at the yield curve down here, this is the yield on bonds, U.S. Treasury bonds. And we go back to the beginning of this year, and the entire yield curve was below 2%. Then we go to today, and the entire yield curve is well above 3%. It's inverted. And we're expecting interest rates to be raised at the short end of the curve the next time the Federal Reserve meets, a couple more times probably. What this does is it makes the financing of everything more expensive. Financing of a house today, if you were to go out and buy a house, the cost on a monthly basis would be roughly twice of what it would be last year for the same house. So this does slow economic activity. But as the saying goes, the impact of inflation and of interest rate hikes has a long and indeterminate path higher. So we don't know how long this is going to take before it slows inflation down to 2%, which is what the Federal Reserve is working for. So here is the total value of the portfolio over time. If you look at it, $78.4 million in total contributions. You can see here is at 68, so it's down $10 million. I can say that we have recovered somewhat since that time. If you look at October, it was strong. November has been also a good month for returns. So this is not a great start. Remember that we did have 2 initial contributions, so we spaced it out, the investment, a little bit. But in retrospect, had we had the crystal ball that was working properly, we probably would have gone in slower. However, we're not in the 1-year or 2-year investment business. This is for the entire future of this fund, which I think should be judged in decades. Moving forward on this, you can see the allocation of the portfolio did not change significantly. We are carrying some cash, which I think is positive. And as we look at the overall allocation, we have 50% in U.S. equities. We have roughly 40% in cash and fixed income. And again, we want to carry a little bit more cash right now because the yields on cash is roughly equivalent to bonds. And we have international equities at 8.5%. Notice that the market value did go down during the quarter, and this is due to market value depreciation. Our portfolio is relatively streamlined. I think there's often sophistication and simplicity. The portfolio may look different 2 years from now, a year from now, but again, we want to cover all areas of the market as efficiently as possible. So our largest allocation is a fixed income fund, a bond fund. The next largest 3 are index funds for the U.S. equity. Then we have our international index fund, and then we have a high yield bond portfolio. Again, moving forward, we do expect to make some further changes to this, but we want the portfolio to mature a little bit more before then. This, you can see our allocation and our reconciliation for the last quarter. Loss in market value, these are not realized losses, this is depreciation, unrealized, of down $3.5 million. We haven't taken any funds out of the portfolio. We don't expect to take any funds out of the portfolio. In fact, I don't think we're technically allowed to take funds out of the portfolio unless we are above the initial $80 million. So that sounds difficult, but in the long term, that protects the corpus of the portfolio from being taken away. And I think that is very much in the design of this trust. So going forward, we have 1 quarter of return for the total fund, down 4.34%. Since inception, starting on April 1 of this year, negative 15%. I don't think there are many other times that we could have hit this started out at a more difficult period of time. But I think that there's a lot to look forward to. When we're looking at our investments on the domestic equity side, they're indexed, large cap, mid cap, small cap, and all of those indexes are tracking their benchmarks very, very closely. If you look out to the inception of the funds themselves over on the right-hand side, you can see that index funds have performed very well, annualizing since 2011 for the Fidelity Fund at 11% per year. 9% per year for mid-cap and 8.6% for small caps. If I look at our international equity portfolio, it's more middle of the road, but the returns have been tracking the benchmark pretty closely, but since there's a currency effect, that benchmark does tend to stray from its benchmark, or that index fund trails its benchmark a little bit more than U.S. And then when we look at our fixed income portfolio, very difficult rates of return here in absolute terms. If we look at relative returns, I think that Dodge & Cox and the Prudential, both those portfolio management teams are quite good, quite strong. You can see the results are good versus their peers. Looking forward, let's see, we've got a little bit of cash there. Again, the yield on cash is strong compared to where it has been for a long time because the Federal Reserve has been so thorough at raising interest rates, and we don't expect that to go down anytime soon. We can go through the calendar year rates of return for the investments here. We don't have it for the total fund, of course, but if we look at the years leading up to 2022, you can see that we had 3 very strong positive years and 1 negative year for the equity markets. But I think this also tells us that markets are highly variable. If you look at the expected return for equities, it's about 10% per year, but those returns almost never fall very close to 10% per year. They're wide range of volatility around that, which is why we diversify, and it's why we rebalance over time to capture some of those returns. I don't want to go too much through this. I'm happy to cover the individual investments. They're very transparent. They're very liquid. If we did need to liquidate something, it would be very easy to do so. But at this time, if we have future contributions coming in, we'll be going to the target asset allocation, which is our long-term discipline and how we drive returns and control risk in the portfolio. So I'm happy to take any questions.
Questions of Doug?
Doug, what return would the fund need to generate to make up for the losses, and over what period of time? Let's assume it's an 8% return or 6% return next year or in the years following.
Well, I mean, the way the compounding math works, 8% return, so we're down, if that's what figure you want to use. Through the end of September, we were down 15.5%, so a little bit more than 2 years. Because remember, when you go down, it's harder to come back up.
Does that align with when the capital will be needed for the projects that are laid out?
Yes and no. I mean, the trust, the requirements of the trust are what they are. There are going to be some projects that are probably going to come online before we get to that threshold. But we've been engaged with those operators, and I don't think that they are not unaware of the situation that we're facing. The one that has expressed that they wanted to kind of tap into their operating funds a little bit earlier. We've had a very focused, deliberate meeting with them a couple of weeks ago. So yes, it's going to put some pressure on our operators. Other questions? So Doug, and I think this is a 2-part question, what are the term of the bonds or the fixed income that we are invested in now? And as interest rates increase, the rate on those bonds should begin to increase, and are we going to be in a position to take advantage of that?
True, very true. If memory serves me, I think that the Dodge & Cox bond fund, that's the big one, has well, why don't we just go back and see? I don't know if no, we've got the abbreviated version here, but if my memory serves me, that has a duration of about 5 years, right? So every 1% increase or decrease in interest rates, it's going to be a 5% fluctuation in the value. And I think the yield on that is a little bit more than 4% right now. If you look at the high yield fund, and that's the one that's a lot smaller, the yield on that has gone up to better than 8%, which is, I've been waiting for this for a while because I have a lot of clients who have actuarial assumptions of 7.5. And so a going in yield of better than 8% is very useful. The duration on that's going to be shorter, so that it would see in between 3 and 4 years. And again, interest rates are moving right now. The 30-year Treasury was about 4.25 2 weeks ago, and now this morning before I came in, it was under 3.9%. So that's a pretty substantial move at the very long end of the curve. And remember, as bond prices go, or as bond yields go down, the price goes up. So we've really got two ways to win with the bonds.
Right.
You know, we move towards maturity. The market value closes with par over time. And as interest rates go down, the price goes up. But then also we have the yield. I like cash yield just because it's good to have that coming in and it's supportive of long-term prices. So 9% for the high yield fund, and probably better than 4.5% for Dodge & Cox because they invest a lot in corporate bonds.
Right. Okay, great. Any further questions? Okay, all right. So maybe move on to item 4. We don't need to vote to receive those, okay. Receive the monthly investment flash report as of August 31st through October 31st, sorry.
Perfect. Thank you. So here is a bit of good news. You can see for the month, S&P 500 was up 8%, Russell 2000 small stocks up 11%. That's 1 month. That's a great recovery, and something that we do often see when we have prices going down in dramatic fashion, a lot of volatility, a lot of worry in the market. Once the market does move up, it tends to go very quickly. If you will see the year-to-date sector returns here at the bottom, again, this is the Russell 1000, but you'll see a huge dispersion of returns and only one part doing really well, and that's energy. If we look over here on the right-hand side, you see oil at 86, which is almost double what it was 2 years ago. Natural gas at 6.36, which was quite high right now. Also, and you see commodities all together up about better than 10% so far year to date, and I think that tells us about inflation. When we look at the yields here on various bonds, this is as of the end of October, again, the prime rate has gone from 3.25 to 6.25 this year, and that is a tremendous increase. I would much rather be a lender at 6.25 than 3.25. And so that does put some more money into the pocket for the bond portfolios. Moving on to the portfolio, 71.2. You can see that we have had an increase, not a lot of change in market value, but the portfolio is at 4.46, and you can see where it came from. Domestic equities were strong across the board. You can see that even international equity was positive. Fixed income, minor loss for Dodge & Cox, but you can see that the high yield fund was positive. And I tracked the portfolio into, as of last Friday, and on a rolling month basis, it was up almost 10%. I don't have those figures here for you, but the continuation, it has moved forward. And oddly enough, over the last month, the best performing asset category has been international equities. The dollar has fallen off, and that has helped pretty dramatically over the last month. So steady as it goes. Sometimes it does, it is the darkest before the dawn. And in markets, when we look at recessions versus equity markets, the equity markets typically recover before we're into the worst part of the recession. Sometimes the equity market recovers before the recession really gets underway. And often in the past, the body that declares recessions sometimes won't even be able to tell us we're in a recession for over a year after it starts. So a slightly upbeat report for October. And I'd like to go into one other, if there are no questions on this.
Questions? Okay.
A few more charts here, if I could. And these are the long-term charts. This is what informs our long-term investment process. And if you look at it, this is the S&P 500 going back to 2007. We go back to 2007 because that was the start of the great financial crisis. Now notice through everything that we have been through over this period of time, we've had several markets that are bear markets. That's a 20% drawdown. Anywhere that's in red shows a drawdown, but you can see the bigger drawdowns are noted as bear markets in there. The most painful period, of course, was 2007 to 2009. You can see the drawdown, how sharp that was, not nearly as sharp as the COVID drawdown, which is right here, or the drawdown that we've seen this year. And also, do note that this year we've had several recoveries through this period of time, right? At the very beginning of the year, the market was most preoccupied with inflation, and inflation was strong. And then February 24th came, and Ukraine was invaded, and so the market was preoccupied with that. But if we look at this, we do see that staying invested is the proper course, even during volatile times. This is an incredibly illustrative chart. What this does is it goes all the way back to 2007. There have been 3,771 trading days. The market's been open that period of time. If you started at the top of the previous market, or the top of the market before the great financial crisis, and stayed invested the entire time, your annual rate of return would have been 7.86. Had you been out of the market, the 5 best out of those 3,771 days, your total return over that time, your annualized total return, goes down to 4.6. So it's a dramatic reduction, just 5 days being out of the market. If you're out the 10 best days, you're only going to earn 2.39% per year. So that's very dangerous for us, wanting to have a 4% return per year. But I will tell you that those 5 trading days were very close to the market bottoms. Again, volatility clusters. We have big down days, then we have big up days right after that. Had you been the worst market timer in the world and been out the 20 best days over that period of time, you would have actually had a loss over that period of time. Now, we're not going to talk about this side because we're not market timers, but had you been out the 20 worst days, you can see how much dramatically higher your return is. We can't do that. We're not equipped to do that. I don't think it's possible. So we base our investment philosophy on this figure right here, staying fully invested. This is also a big part of it, and it's another way to look at the consistency of the equity market over time. This goes back to 1926, so we've got almost 100 years of data here. And this tells you that every 1 year period of time based on monthly returns, so it's rolled a month forward every time. There are 1,150 rolling 12-month periods of time that we can go back to 1926. You can see that 75% of the time those returns are positive, and over that, all of those average rolling returns is 12.43% average rate of return. We go to the 5-year period of time, all the 5-year rolling periods, 88% of the time were positive, and that average return is 10.26. If you go out to a 20-year time horizon, which I think is consistent with what we're trying to do here, there are 0 20-year periods since 1926 for the U.S. equity market that have had a negative rate of return, 0. 100% of the time, equities have had a positive return if you're able to hold them for 20 years at a time. And the average rate of return for those 922 years is 10.81%. So that gets us where we need to be as the trust. I'm going to go here to the bond market. This is the Bloomberg U.S. Aggregate Bond Index. And what this shows us is the return of this index over time. Unfortunately, the bond market is not like the equity market. It's a dealer-driven market, so there's not a market clearing price. These are inventories. Picture a car lot more than the stock market, and that's what bond markets are more like. But and that's why I'm saying that, is that we don't have as long of a history. But if we look back to 1976, we can see that we're in the worst bond market ever. By this is the S&P 500 of the bond market. So the Bloomberg aggregate market, the worst period of time to be invested in is right now. It's down 16% for this entire drawdown. If we look at the previous worst drawdowns, is March of 1980, down 12.6. So it's been, we're significantly worse than we were then. And if we think about why we had that in 1980, it was oil prices and inflation. That was the big reason. You can see the next worst one was September of 1981, down 9%. And then we go to 1994, down 5.15%. So we're in a different area than these previous bond market drawdowns. Again, we started with low interest rates. We had inflation come on very quickly, and that's what pushed bond prices down so rapidly and so to the degree that they have been. Now, this table in the middle of the chart tells us what happened after the bond markets drew down in previous times. So March of 1980, once that market dropped down, or once it hit the bottom, interest rates started moving lower. The one-year return was 10.51. The two-year annualized return was 10.79. 3 years was 17.8. So these are tremendous returns for the bond market, much higher than what we expect most of the time. The 1981, you can see how strong those returns are in the 1994. Again, bond markets do snap back. Sometimes it takes a little bit longer, but we've never seen a situation like it is right now. I don't expect long-term interest rates to go back down to below 2%, but even a modest recovery from where we are today will be a significant recovery in bond prices. So that is all that I wanted to cover today, and I'm happy to answer any more questions.
Any questions over the October 31st report or these additional slides?
No questions, but I just, in observation, of course, I'm on the OPEB trust too, so I saw some of these slides at the OPEB trust. And even in spite of that, this morning my brain was screaming, put it all in cash, get a mattress, put it in, dig a hole in the backyard. So I appreciate seeing the slides again and being reminded that if we miss those best 5 days or the best 20 days, God forbid, that, you know, what an issue that could cause for us long term, how reinforcing that patience is so important.
If I may, as I look a lot at behavioral investing. It's not necessarily the most popular area of academics, although it's making inroads there. But one thing that I'm going to cue off something that you said very specifically. Your brain got up and it was saying sell everything. And there's been a lot of research done on that. And our brains are not evolved to be the most effective investors we are. Our brains, that part of the brain, the very primitive part of our brain, the fight or flight mechanism, which is meant to keep us safe from predators, going that far back, that is the response that you're having. It's not a rational response. In fact, there's in defined contribution plans, right, 401ks, 403bs, et cetera, there's a ton of research done there because a lot of people want to motivate their workers to save as much money as possible. And they've found out that it is virtually impossible to have educational campaigns that teach people how to be great investors. The best way to ensure that your participants have the maximum balances is to take all the choice out of their hands and automate the process as much as possible. Right, so if you look at target date funds, if you look at what's called automatic enrollment, you know, somebody gets a new job in a new company, we're automatically going to put them in the plan. We're going to make them save 6%. That is the best way to do it because our brains are not equipped. And if we, you know, if we're being very, very clear here, they're not equipped to be good investors because when it's, you know, the worst time, the most painful time to be an investor is when the markets are going down and when prices are low. The best time to be a long-term investor is when markets are down and the prices are low. So thank you for your patience. I know I spoke a lot today, but it is important. We're in the early phases of this trust, and sometimes these lessons are hard to take, but it is the path to being a good long-term investor.
Well, let's hope we're just getting the pain out at the beginning and then we'll be done. Right. Any other questions or comments? Okay. We do need a vote to receive this report, so I take a motion in a second. Cast your votes. Motion is received. Thank you.
Thank you.
And Doug, we do appreciate the analysis, but also the explanation. It helps us keep level.
Good. Thank you very much.
Okay. Moving on to item 5, the calendar year 2023 meeting schedule. Don't believe, yes, we need a motion and a second to approve. Please cast your votes. Okay, the motion passes. Now moving on to item 4, we have to ratify claims. We have 3 claims totaling $28,849.73. These claims are for the investment consultants as well as the custody bank services. If we don't have any questions, I take a motion and a second to approve. Please cast your votes. Motion passes. Thank you. Moving on to item 7, individual items for consideration. A, renewal of agreement with BOKF, DBA Bank of Oklahoma for custody services. The estimated cost is $30,000. This is year 2 of a 5-year contract that was originally approved in November of 2021. But we have to ratify, we have to approve this annually. So there aren't any questions. I would take a motion in a second. One second. There we go. Thank you. Please cast your votes. Okay, the motion passes. Thank you. Okay, item number 8, reports, comments from the trustees, staff, and interested parties. Do we have anyone signed up to speak today? No? Any staff comments? Okay. Any trustee?
Madam Chairman,
Yes.
I would just like to mention, it being the month of Thanksgiving, there are a few of us up here that are city employees, and we get paid to be here. So I just want to say how thankful I am for you and all of our board members who are citizen trustees who put so much of their time and attention into this particular activity. All of the boards, trust commissions that serve the city are very important, and without all of you volunteering your time, we would really be in a world of hurt. So thank you all very much for being here.
Well, thank you for those comments, and I would echo and say I am grateful for each of the volunteers, but also tremendously grateful for the consultants as well as the staff. You all truly do make it easy for the volunteers to show up and do our thing, so thank you all. Anything else? Okay. If not, I would just say oh, I'm sorry, Jessica.
Yes, I have a little guest here with me in the back row behind David back there. She probably knows more about MAPS 4 than most city people in Oklahoma City, and that's my daughter, Lucy. So thank you for sticking it out for another MAPS meeting once again, Lucy.
And we are always happy when you join us, whether you are or not, we're happy to have you. So come anytime. Well, and if we have nothing further, I would just say happy Thanksgiving to everyone. I hope you have good, safe holidays. If nothing else, we'll move on to item 9, motion to adjourn. Okay, please cast your votes. Now we better be unanimous. Okay, great. All right, motion passes. We are adjourned. Thank you so much.
Well, no, I want to stay.